Hello everyone. This video is going to be chapter 6, cost behavior. If you remember in chapter 2, we learned the building blocks of managerial accounting, where we talk about different kinds of costs. If those are the building blocks of managerial accounting, then chapter 6 and 7 are going to be the walls for, if you say managerial accounting is a building. So chapter 6 is very, very important, and it's a very long chapter. I highly recommend that um, you just watch through this video and to fully understand what I'm talking about and what is covered on the textbook. So this video is just a complement of your study. I think you have to read your textbook or the course content on eCampus as well to fully understand all these contents and how to do these calculations. So chapter 6, cost behavior, we basically are talking about to differentiate different kinds of costs. And instead of what we did in chapter 2 and 3, that we differentiate between direct labor, material, and manufacturing overhead costs, this time we're going to deal with variable costs, fixed costs, and mixed costs. And these are going to help you make decisions when it comes to do business. And chapter 6 is the basic introduction of these 3 different costs, and then we are going to introduce the contribution approach income statement, which is different from our traditional income statement on the financial report. We're going to get to that later. So first, there are 3 common cost behaviors. These are variable costs, fixed costs, and mixed costs. And then the variable cost is that the total of the variable costs will change in direct proportion to change in volume. And then the variable cost per unit will remain constant. So here is a very simple example is, assume you have a smartphone plan that charges 5 cents for every text you make. And then we can graph the relationship between the number of texts in a month and the total monthly cost. So for example, you can see that it starts from 0, where, if you owe, so I think most of the phone firms right now are offering the flat rate, but just imagine that what we did in the past. If you don't make any tests, then you will be charged $0, nothing. And then the more tests you make, the more you're going to be charged. And then the amount, the total dollars you have to pay for the test will depend on the total number of tests that you make, okay? So the cost line begins at origin, 0 volume and 0 cost, and then is a straight line. When you look at, so here you look at a vertical axis, it says cost per text, cost per text, and then the cost per text will remain constant no matter how many texts that you make, is 5 cents per text, okay? In fixed costs, I think this is, most of the phone companies are doing right now, which is a total fixed cost, and the total cost will remain constant instead of unit cost for fixed cost. And then the fixed cost per unit of activity will vary inversely with changes in volume. What does that mean? So assume your cell phone plan includes unlimited minutes of talk time, which most of the cell phone companies are doing. So say you pay $30 per month, okay? And then no matter how many minutes that talk that you make, phone calls that you make. So this is the vertical line is the total cost. You can see that no matter how many minutes that you talk, you're gonna pay a straight payment of $30. If you look at a second graph, is cost per unit. The cost per unit talked will decrease as the number of minutes talked increases as follows. So it's really easy to understand here. So for example, if you pay $30 per month, then let's say very extreme example that you only make phone call for 1 minute during the month, then the cost per unit will be $30 because you only make 1 minute phone call and you pay $30. Then you paid $30 for 1 minute phone call. But if you talk like 10 minutes during the month, then and you pay a total of 30, then that means your average cost for per minute will be $3. Okay, and then you can see that the cost per minute will decrease as you increase your number of minutes talked through the phone call. So this is a total cost, and these are the properties for total cost. And we also have a mixed cost. Mixed cost is a mix of total of variable cost and a fixed cost. It has a flat rate, but you also have to pay extra as the volume increases. So for example, there's a cell phone plan that the fixed cost is $30 for unlimited talk, but you have to pay extra dollars if you have text. So this is fixed cost of $30 you pay, and if you don't make any tax, then your total cell phone bill will stay constant by at $30. But if you start to make tax, the more tax you make, the more total cost it will be. So the main difference between mixed cost and the variable cost is that you can see that the mixed cost line does not start from zero because it contains a fixed cost component, while the variable cost graph starts from zero. Okay, now let's look at this example. You should be able to identify the cost behavior through these examples. So these are activity level: 5,000 units, 6,000 units, and 7,000 units, and these are the total costs. So let's look at the first one. Total cost A. It starts from 15,000 and then 16,000 and 17,000. So we can see that at first it is not a fixed cost, if you agree with me, because a fixed cost will stay constant no matter your activity level. Okay, so let's do it the other way. How about we identify fixed cost through all these examples first? Okay, so if you look at that, you can see 3, total cost C will stay constant. So this is fixed cost, and then D, and then 4, $2 all through. So this is also a fixed cost. And if you look at, how about 2, total cost B, you can see for 5,000 units, total cost is 5,000, 6,000 units, total cost 6,000, 7,000 units, total cost 7,000. So it's like proportionally increasing the cost as your units increase. So we'll say that this is a variable cost, okay? how about the first one? Total cost A. So it looks like that if you compare 1 and B, okay? See, we already identified that total cost B is a variable cost because it's changing proportionally. And then total cost A looks like it's like you add every total cost B by $10,000. Okay, so it looks like it's a variable cost plus a $10,000 to every level of units. So we'll say that this is a mixed cost. Okay, and if we look at oh, I'm sorry, I made a mistake. So 4 is per unit cost B. Okay, so per unit stays constant. Then what cost is that? It's a variable cost. And then 5 per unit cost. Per unit cost E. I think we should calculate total cost first and see what the results are. Okay, so if you do a 3 times 5,000, that's 15,000, right? And they do a 2.5 times 6,000 is also 15,000. Do a 2.14 times 7,000 is also 15,000. So we will say that this is a fixed cost. Okay. Stack cost. Stack cost is a it stays as a fixed cost for a small range of volume and then jump to a new level with moderate change in volume. And this is a very good example is the caregiver to child ratio in daycare center. For say like 2-year-old, the child caregiver to child ratio is 1 to 8. So if you have 1 kid through 8 kids, you only need 1 teacher, and the total cost is, for example, $15,000. But if you have 1 more kid, like you have 9 kids, then you're gonna need 2 teachers, and then your total cost will double. And all through 15 kids, you know, you only have 16 kids, you only have 2 teachers, but then when it jumps to 17, you're gonna need 3 teachers, and so on and so forth. So this is a step cost. This is another exercise to identify the graph that most closely represents the cost behavior. Okay, let's look at the first example. Straight line depreciation of equipment. What does that change? No. So this will stay constant, and then it's not 0. It's not start with 0. It's a depreciation amount, so it has to be more than 0. So this is 1. And the next, monthly electronic bill, which consists of a flat monthly service charge plus a 0.002 per kilowatt hour. So you can see there's a flat charge, and then the more kilowatt hours you use, the more you're gonna pay. So I would say that it looks like it's a mixed cost with a increase line, but it does not start with 0 because you're gonna pay a flat monthly bill. So this should be 5. And next, factory rent of $3,000 per month, which will be forgiven by the city if the company employs 12 disadvantaged youth. The x-axis is the number of disadvantaged youth employed by the company. It looks so if you look at this, you pay $3,000 if you hire less than 12 disadvantaged youth. And then if the number of disadvantage use exceeds 12, then you pay 0. So it looks like it's 8. Okay. For less than 12, you pay 3,000, but for more than 12, you pay 0. So this is 8. Office rent of 1,500. So it's a flat rate, it's a flat number, it's a fixed cost, so it should be 1. Tuition is 385 per semester, credit hour up to 10 credit hours. Tuition for 11 credit hours or more is 4,215 each semester. I think it's a normal policy for most of the universities. The number of the tuition you pay will be proportionate to the number of credit hours that you take, but you're gonna take the credit hours for free if it exceeds a certain amount. So it should be 3. Okay. As your number of credit hour increases, your cost increase, and then it will stay flat after a certain amount of credit hours. F. Salaries of delivery workers, where delivery person is needed for every 200 deliveries scheduled in a given month. With less than 200 deliveries, you're gonna pay a certain amount. But if more than 200 deliveries, you're gonna need 1 more person, and then so on and so forth. It's very similar to the caregiver to children ratio in daycare. So this should be 11. It's a step cost. Okay. G. Cost of direct material for picnic tables when the wood costs 45 for each table. So this one is a variable cost. And if you produce 0 picnic table, your cost should be 0, right? And the total cost for wood will be proportionate to the number of tables that you produce. So this one should be 2. H. Cost of water used in plant with that has a flat fee of $10 per month plus the following price schedule per gallon of water. If you look at that, if you use less than 10,000 gallons, your cost is 0.5 cents per gallon. But if it exceeds 10,000 until 20,000 is 0.6 cents. So that means the rate is increasing, and also step cost. So if you look at that, we can see that number 7, the slope is increasing. Okay, so this one should be 7. And then cell phone bill of $29.99 per month for 450 minutes plus 0.25 per minute above 450. This is a flat rate before 450 minutes, and then there's an increase after that. If you look at that, it should be 9. Okay, 9 starts with a flat rate, and then there's an increase. Okay, as the volume increases. Last one, salesperson earn $10 on each unit sold. This should be 2. Okay, it's a variable cost. If you sell 0 units, you get 0 commission, right? Okay. All right, cost equation. If you are managerial accountant, you have to analyze the cost for the firm to see how we are utilizing our materials, our resources efficiently, and then to figure out how to eliminate cost in a certain department or area as much as possible. So total cost will be equal to total variable cost plus total fixed cost. And then if you write in the formula, it's Y equals to Vx plus F, where X will be equal to the number of units that you produce, and then or we say volume activity, and then Y is a total mixed cost, V is a variable cost per unit, and F is total fixed cost. We use cost behavior for decision making. First is you have to keep in mind there's a relevant range. What is a relevant range is it's actually can be explained as band of volume or capacity. Say for example, let's look at a pizza store like Domino's. Okay, I don't know which pizza store you like. Let's just use Domino as an example. If you look at Domino's, you can see that just imagine that the more pizza that they produce, the more raw materials they're going to use to produce this pizza, like flour, Italian sausages, meat or something like that. But each store has a limit, has a capacity. If you look at the store on the Manvoris Road, they cannot produce like 10,000 pizzas each day because it exceeds the capacity, the volume. So first thing you keep in mind that you will have a relevant range, and then you must be sure that the planned activity is within the relevant range. Okay, otherwise it's just not valid analysis. And committed fixed cost cannot be changed in the short term. So that you have to keep in mind, if you do any planning, fixed costs will stay unchanged, such as if for Domino, the house rent will be fixed costs, right? And then there are also some other discretionary fixed costs. When we talk about fixed cost, it just means that it is fixed because it does not change as your activity volume change. But it doesn't mean that fixed costs will stay constant all the same, because fixed costs can be changed in the short run, such as you can do advertising, and advertising cost does not change as your activity volume change, but you can make a decision whether to do advertising or not. Okay, so that's why this is a discretionary fixed cost. Here is an example regarding how to determine the cost, and then if you have some amount, some number like fixed cost or variable cost, and then it's just to squeeze out the equation. And if you have some of them but not the others, how can you figure out the rest? Okay, let's play with this example together. Complete the following schedule related to a dry cleaning business with 3 volumes shown. Okay, this is a dry cleaning business, and then this 3 columns represent 3 volumes or activity volumes. First, if you look at this, you only have 2 numbers in the table, but you have to be able to fill in the rest of them. This is a very good example and a very good exercise to do. First, I think we can use this, start from this fixed cost per garment. I think that because this is the easiest one to do. The fixed cost per garment, it's $2 if you have 3,500 garments. Then what is your total fixed cost here? Will be $2 times 3,500, so it's 7,000. Okay, so and as soon as you have a total fixed cost, you know that total fixed cost will stay constant. So that means total fixed cost will be 7,000 for all the other activity volumes. Okay. All right. So next, we're gonna do this one. Variable cost per unit. Okay. How to do variable cost per unit? Because we have the total variable cost. Now we have the total number of garments that we do. So we simply use the 2,625 divided by 3,500, and then that we got a $0.75 variable cost. Okay, and we know that variable cost will stay constant. Then we know that we can fill in, all this line, all these cells with 0.75 because the variable cost per unit will stay constant. As soon as you finish one of those, as soon as you figure out one of those, you can fill in the others because they stay the same. So again, on this table or anytime we talk about this variable cost and fixed cost, only two things stay constant. One is total fixed cost, and the other is variable cost per unit. So these two things will stay constant. Okay, so that's why we should figure out, either of these first, and then just fill in the rest with the same number. Okay, so now we have variable cost per unit. Then we can figure out the total variable cost by multiplying the variable cost per unit by the total number of garments. So 0.75 times 2,000. So we know that the total variable cost for 2,000 garments is 1,500, and then this is 3,750. Okay. Then we can calculate total operating costs, okay, by adding these two together. So this is 8,500, and this is 9,625, and this is 10,750. Okay. Okay, let's go down here. Fixed cost per garment. We know total fixed cost is 7,000, and then this is the total number of garments. We just use the total fixed cost divided by the 2,000. Then we have 3.5 dollars. And then for this one, total fixed cost is 7,000. Total garment is 5,000. So we do a 7,000 divided by 5,000 is $1.4. And then average cost per garment will be the total average cost of these. So let's add these up. It's 4.25. This is 2.75. 2.15. Okay. So you have to be very, very familiar with what we did on this table. Then you will be at least, understand, you're at least good for 80% of this chapter. So question is, why does the average cost per garment change? Why does that change? So it has two proportions, variable cost per garment or fixed cost per garment. While variable cost per garment stay constant, fixed cost per garment changes, right? So the answer is the fixed cost per unit varies inversely with changes in the activity level. Okay. Question 3. Suppose the owner erroneously uses the average cost per unit at full capacity to predict total cost at a volume of 2,000 garments. Would he overestimate or underestimate total cost? By how much? What is a full capacity? we'll just assume that it's 5,000, okay? So the owner erroneously used the average cost per unit, which is 2.1415, to predict total volume of total cost at a volume of 2,000 garments. And then if you do that, total cost will be 2.15 times 2,000, okay? Because this is total variable cost. And then you got $4,300. And then, okay, this is error, right? This you erroneously did that. And then what is the difference? Did he overestimate it or underestimate total cost? What is the real total cost? It's 8,500, right? So he is underestimate total cost by 8,500 minus 4,300, which is $4,200. It is very huge, right? It is very significant. Okay. Okay. Let's work on some more examples just to make sure that you understand, and then to help you with your upcoming quizzes and exams and projects. Okay. Next question. Mailbox Magic produces decorative mailboxes. The company's average cost per unit is 26.43 when it produces 1,000 mailboxes. What is the total cost of producing 1,000 mailboxes? We know the average cost per unit is 26.43. So total cost will be equal to 1,000 times 26.43. And the answer is 26,430. Okay. And this is the total cost. Next, if 18,000 of total cost is fixed, what is the variable cost of producing each mailbox? All right, so now it comes to the cost function, right? Total cost will equal to variable cost, and that is associated with X and plus fixed cost, right? And in this equation, what do we have? We have a total cost of 26,430. And what is the variable cost per unit? That is what we need to figure out, right? And how many units are we producing? 1,000. Okay, what is the fixed cost? It's given here is 18,000. All right. So if you want to derive this, you can see that VC 1,000 will be equal to 26,430 minus 18,000, which is, let me calculate, minus 8,430, okay? And then what is VC? VC will be equal to 8,430 divided by 1,000, and then the answer is 8.43. Okay, so this is our VC. You have to learn to do this function. I always recommend that you write out this function first and then fill in what you have and then you solve what you don't have. Okay. Okay. Next, write mailbox magic's cost equation. So cost equation, y would be equal to VC. What is the V here? 8.43. Okay. X plus fixed cost $18,000. Okay, so this is mailbox magic's cost equation. If the plant manager uses average cost to produce total cost determined is forecasted for 1,200 boxes. So if you do a prediction, you're gonna figure out y equal to, let me make it purple. So you have 8.43 as variable cost, and then how many we're producing? 1,200, and fixed cost 18,000, and then that gives us 28,116. So this is, once you have the equation and you have x in this problem, you have x, then you can figure out y. Okay. So you can do the rest. Let me see. Oh, I'm sorry. I did it wrong. So this should be y, because it says the plant manager uses cost equation. Okay. So 4, if the plant manager uses average cost to predict total cost. What is the average cost? Average cost is 26.43. Okay. 26.43 times 12,000, that will be equal to 31,716. Okay. If you do that, you actually can compare the difference if you use average cost to predict total cost or the cost equation. Actually, the cost equation will be more accurate because it differentiates between variable cost activity and the fixed cost activity, and it more reflect the truth. Okay. So number 6, is actually, we answered that question already. Okay. I would just skip the next example because it's similar. You can do that by yourself, and then let me know if you have any questions. Okay. Sometimes we don't have the detailed information to help us figure out variable cost per unit, but we have some very vague information, like just the number of units and then the total cost. And sometimes they do not see a very good pattern, you know, if you use your eye, just look at it. So we're gonna use some techniques to figure it out. The first one, okay, so I'm gonna skip this example on fixed or variable cost. If you do that by yourself and wanna check your answers, just let me know. Okay. So we can do do some examples for the techniques to figure out your cost function. We can do a scatter plot. If you haven't done scatter plots, so this is an example of the scatter plot. You have 2 axes. This is the volume, activity volume, and the vertical line is your total cost. Okay, this example is the delivery van company. The horizontal line is the miles that you drive, and then the vertical line is your van operating cost. So this is a table. They don't know their variable cost. They only know, how many miles they drive, and this is their operating costs. And then they put all these, so for every month there's a dot here. They put the dot here, and then as a scatter plot, you can see that trend that at least, so it seems like a mixed cost is increasing. And then the first question is, does that appear any outliers? What is outliers? Outliers might be, you see that all these dots seem to be staying on the line, but what if there's a dot here or a dot here? Then that should be outliers. So we would say that there's no outliers, okay? And then second question is, how strong of a relationship between miles driven and van operating costs in there? I would see that this relation seems very strong, okay? Because it's seeing a upward trend, and then the total cost increases as your miles driven increases, okay? And then we're gonna do we can use a high-low method to figure out our cost function. The high-low method has an advantage because it only uses the highest and the lowest activity points, okay? Pay attention that this is activity points, which is X, okay? Highest and lowest activity points, and then you use a scatter plot to determine if the linear relationship exists. If so, we can just use a high-low method to estimate our cost equation, okay? The steps, so first, you find your highest and lowest activity levels, and then you do a change in cost and change in volume between these high and low points, and you figure out your V. Then you put your V in the cost equation for either the low or high point, and then solve for F. In this way, you have both V and F, then you have your cost equation, okay? Let's do this example. Let me hide this first, okay? Use the data from the previous problem, use the high-low method to determine power's cost equation for van operating cost. First, you need to find out what is the highest X and lowest X. So here you can see the highest is over here, 17,300. And what is the lowest point? It should be here, 14,100, right? And this is the corresponding total operating cost. So we can see that on top of the line, we should put Y, which is the total cost, and use the highest point minus the lowest point. So we can see the highest point is 5,680. 5,680. And then the lowest point is 4,880. And then the horizontal, X and the highest X is 17,300. And the lowest is 14,100. And then after this, we can get is 25 cents per mile. And this is our V, okay? If you see the equation, this is V, okay? And then step 2, you can write down here what is the highest, or like you can use either either point, but we can use the highest point. 5,680 is y, and then y will be equal to, what is v? V is 0.25, we just figured it out here. And then x for the 5,680 is 17,300, okay? And then plus f. If you use this equation, you can figure out f. Equal to 1,355, okay, by solving this f. So now we have both v and f. Then we know the cost equation is y equals to 0.25, 0.25 times x plus f is 1,350. And then you can use your result to predict any van operating cost and volume of this number, and you can put 15,000 here. And then I will just copy and paste the answer here. Okay, y will be equal to 0.25 times 15,000 plus 1,350. And this is your total cost of the volume of 15,000. Yeah, I'll just skip this. Advantage is quick and easy to use, but disadvantage is only use 2 data points, and then these points may be abnormal. You have to make sure they're not outliers. Okay. We can also do a regression analysis. So this is an advanced technique. Let me see if I can copy these numbers to Excel, and then we can figure it out. Let me show you how to do this. All right, so now I think you are looking at my Excel. These data are obtained from our example before. If you look at your data tab, usually here you will see data analysis. But if not, you can go to File, Options, and then with your add-ins, Analysis Tools, you click these analysis tools, and then okay, just install that. Let's see. Yeah. And then you'll see data analysis here. Okay. And then if you click data analysis, you can see choose regression. Okay. After you choose regression, input y range. Which is y? The cost, right? So actually, you can choose this. This is your y range, and what is your x range? It's the miles driven. Okay. You can actually just choose, choose the column including the title, and then you click labels so that Excel knows that the first line is labels, and they will not include that in your regression. And you can do residuals or not, and confidence level 95%. You can click OK. After you click OK, this is your summary report. from Excel, and you can see that here coefficients, we need to look at coefficients, and then the miles driven coefficient. So this one is our V, okay? Actually, this one is our V, and then the intercept will be over F. So that means the cost equation for this data set, okay, for this miles driven and operating costs, the cost equation will be equal to, will be y equals 0.28, I just round to 2 decimals, times x plus our f. F will be 930.60, okay. So this is how we pull out the results from our coefficient. Okay, let's go back to our Word document. Okay, so this is a regression. So the last thing in this chapter that I want to talk about is contribution margin income statement. Okay. So contribution margin income statement is different from a traditional income statement. You can look at this table here. The left column is traditional approach income statement. We start with sales and less cost of goods sold. Then we have gross margin, and then we do operating costs, and we have operating income. We have been doing this for a lot of time. But for contribution approach income statement, we start with sales, is the same, but we do variable cost first, and then we do a contribution margin. Okay, so that means the contribution margin actually means, you know, how much you get after, you know, you cover all these variable costs. And then we do a fixed cost, and then we have operating income. So basically, the either way you use these income statement approaches of income statement, you're gonna have the same operating income. But the traditional approach income statement is more aligned with the SEC requirements, so it is used primarily for external reporting, while the contribution approach is more used for internal purposes. So in this managerial accounting class, you'll see more of these contribution approach income statement with sales less variable cost, and then we do a less fixed cost. And we're gonna do a lot more analysis on this in chapter 7, which we're gonna figure out our break-even point and things like that. Remember, contribution margin will be equal to sales minus the variable cost. Okay. And okay, here is thing. Traditional approach is also called absorption costing, and it is required by GAAP and tax reporting. But contribution approach is also called variable costing. Just some concepts that for you to understand. If we talk about absorption costing is traditional approach, and if we talk about contribution of variable costing, we are referring to this contribution approach income statement where we differentiate variable cost and fixed cost. Okay. Here are some examples. Let me see. Yeah, I think we can do this example to help you have an idea of what a contribution approach income statement looks like. This table here is an example of traditional or absorption costing approach income statement. We start with sales revenue minus cost goods sold, and then we have gross profit, and then we have all these operating expenses to come to our operating income. We have more information here. Let's read this information. All of the cost of goods sold is variable, and 19,000 of selling and marketing expenses were variable breakout. Only 20% of the remaining selling and marketing expenses and 25% of the website maintenance expenses were variable. Of the other operating expenses, 90% were fixed. Based on this information, prepare precious past income statement in contribution margin format. The framework, the format of the income statement has been given here. We simply need to put in these numbers. So first, sales revenue, I will just copy and paste here because they are the same. And then we look at variable expenses. First, cost of goods sold. The information said all cost of goods sold is variable, okay? So we simply copy this number here. And then variable selling and marketing expenses. Okay, sorry, let me just look here. If we look at the information, it says 19,000 of the selling and the marketing expenses were variable breakout. Only 20% of the remaining were variable. So here we know that we have 19, okay. We have 19 here. So 19 of these are variable cost, okay? And then let me find some place to work on this. So 19,000 are variable cost. And then 20% of the remaining are also variable costs. So what is the remaining? We have a total of 61,000, and then we already count 19,000, right? And then this is the remaining, and the remaining we have 20% as variable cost. Okay, so our total variable selling and marketing expenses will be, if we calculate that, is 27,400. Okay, so this is our variable selling and marketing expenses. And also we have variable website maintenance expenses. And here in the instruction, it says 25% of the website maintenance expenses were variable. And the total is 56,000. So this should be 56,000 times 25%. And that gives us 14,000, okay? And other variable operating expenses, 90% were fixed. So we have a total of 17,000. 90% were fixed. That means 10% are variable. So 10% of 17,000 is 1,700. And then if you calculate the total of these, it should be 708,100. Okay. And then contribution margin. What is the contribution margin? Contribution margin will be sales revenue minus total variable cost. So that should be 278,900. Okay. And now we've figured out the fixed expenses. You're gonna use the same way, you know, for all these expenses. If you deduct the variable portion, the rest will be fixed portion. I would just skip all the calculations and give you the numbers. This is 3,600. This is 42,000. This is 15,300. And then total fixed expenses is 90,900. And then operating income will be contribution margin minus total fixed cost, and then that is $188,000. Okay. So you can see the total operating income will be the same, no matter which approach that you use. Okay. So I think you can do the following example. This example by yourself is very similar to what we did. And if you have done this and want to check your answers, just let me know. Again, chapter 6 is very important. And then the most important thing is to figure out the total cost equation. And then for if you have some of them, how can you squeeze out the rest of that? And then how to figure out the cost equation using different techniques. So this is all for chapter 6. In chapter 7, we're gonna do more through this contribution approach income statement, and then figuring out break-even points or like things like that. All right, thank you very much.